Welcome back to Talk Tickers, where we strip the fluff from the earnings calls and get straight to the alpha.
And today, the ticker is VZ.
The movement is vertical. And the narrative, well, if you were watching the tape yesterday, you saw a complete hard reset.
Oh, it really was. We haven't seen price action like this from a legacy telecom giant in years. Verizon reported their Q4 2025 earnings and the market. It didn't just nod politely.
No, it voted with a massive wallet. Shares ripped 11.79% to close at $44.52.
That is a huge move for a stock that usually trades, with the volatility of a bond.
I mean, exactly. Verizon is usually the stock you park cash in when you want to sleep at night, not when you want a double-digit pop in a single session.
Right. And the volume was the real tell here. We saw about 113 million shares trade hands.
Wow.
That is nearly 300% above the 3-month average. Look, when you see a large cap stock like Verizon move that aggressively on triple volume, that is not retail traders chasing a headline on Reddit.
No, that's institutional conviction.
That is the big money re-rating the company in real time.
It feels like the market finally woke up to what CEO Dan Shulman is doing. This is his first full quarterly report, right?
It is. He's been in the seat for exactly 100 days.
100 days.
And he didn't come out whispering. He came out swinging. This earnings call was a strategic pivot. We have a lot to unpack here because on the surface, the numbers were good, but under the hood, the philosophy of how this company makes money has fundamentally changed.
Okay.
We're looking at a turnaround story centered on what he calls volume-based growth, a massive capital return program that, frankly, shocked the floor, and some very aggressive cost cutting.
All right, let's set the table with the headline numbers first, just so we know what we're working with. They beat the street, correct?
They did. Adjusted EPS came in at $1.09.
Beating the consensus, which was what, around $1.05 and $1.06?
Yeah, hovering right around there. And revenue hit $36.4 billion, which was a roughly $300 million beat, up about 2% year over year.
Okay, so a solid beat. But let's be real, in telecom, revenue figures can be misleading. We've seen telcos hike prices to pump revenue while their customer base walks right out the back door.
We call that revenue vanity.
Exactly. You can show growth for a quarter or two, but if you're losing bodies, you're just dying a slow death.
Right. Revenue is vanity, subscriber count is sanity. And that is where the wow metric came in this quarter. The sanity check was incredibly bullish.
So what was the number?
Verizon posted positive 616,000 postpaid phone net adds.
Wait, 616,000? That number seems incredibly high for a Q4.
It is. To put that in perspective, that is the best Q4 performance Verizon has posted since 2019. Consumer postpaid alone was 551,000 of that.
That's a huge reversal. I mean, for the last few years, the prevailing narrative on Wall Street has been that Verizon is the donor bank for the industry.
Bleeding customers to T-Mobile and AT&T every single quarter.
And this print just stopped that narrative cold.
It did. 600K ads is T-Mobile territory. Seeing Verizon put up those kinds of numbers suggests something has shifted in the competitive landscape.
And it wasn't just mobile, was it? I saw some strong numbers on the broadband side, too.
Broadband is the other engine here. Total broadband ads were plus 372,000. Most of that, came from fixed wireless access. That's their 5G home internet product.
How many did they add there?
They added 319,000 subscribers. The base for that product is now over 5.7 million homes.
So they are winning on the phone, and they are winning in the home. But here is the skeptical trader in me asking the question. Winning customers costs money.
Always.
Usually when I see growth like that in telecom, I expect to see margins getting crushed because they're giving away free iPhones or engaging in some brutal price war. Did they burn the furniture to heat the house?
Surprisingly, no. And this is where the CFO, Tony Skiadas, he deserves some credit. Full year 2025 free cash flow landed at $20.1 billion.
$20 billion.
They funded this growth while keeping leverage in check. Net unsecured debt to EBITDA is sitting at a nice 2.2 times. So they grew the base without blowing up the balance sheet.
That's a healthy ratio for a utility-scale telco. Okay, so the print was good. But you mentioned a philosophical shift. Shulman used a phrase on the call that really stuck out to me. No empty calories.
Right.
It's such a distinct way to talk about a telecom business. What does that actually mean in practice?
This is the most critical part of the deep dive, and honestly, it's why the stock ripped.
Yeah.
Shulman explicitly stated that the old industry trick of raising prices on existing customers without adding value, it's a dead end.
He called it empty calories.
Exactly. You raise the price, your revenue looks great for 1 or 2 quarters, it tastes good in the moment, but your customers get angry. churn creeps up, and eventually they leave.
It's short-term gain for long-term pain. You burn the relationship for a few extra bucks on the ARPU.
Precisely. He laid out the map on the call. It was pretty stark. He noted that churn has crept up 25 basis points over the last 3 years.
Now, 25 basis points sounds tiny. That's 0.25%.
It sounds tiny. But in a base the size of Verizon's, every single basis point represents 90,000 customers.
Wow. So a tiny tick up in churn is nearly 100,000 people walking away.
Exactly. So Shulman said, we are done digging that hole. He is stopping the empty price increases. He basically said, we aren't going to raise your bill just because we can.
I love that from a consumer perspective, but let me play devil's advocate here. As an investor, that scares me a little. If you stop raising prices, where does the revenue growth come from?
Right.
You're cutting off a major lever for growth.
And that is the trade-off. And management was brutally transparent about it, which I think the market really appreciated. They told the street to expect flat wireless service revenue in 2026.
Flat revenue usually tanks a stock. Why did this rip 11%? Usually, if you guide flat, you get punished.
Because of what they promised in exchange. They are targeting 750,000 to 1.0 million postpaid phone net adds for 2026.
So a massive acceleration.
A massive acceleration. We are talking 2 to 3 times the levels we saw in 2025. The market bought the logic. Trade short-term price hikes for long-term volume stability. If you stabilize the base, the lifetime value of those customers outweighs that short-term bump from a price hike.
Okay, so they are going for volume. But if revenue is flat and you're adding more customers, your costs usually go up. More support, more data usage, more equipment. How do you protect the bottom line?
You take a hatchet to the cost structure. And this is where the Shulman turnaround gets aggressive.
How aggressive?
In Q4 alone, they executed a headcount reduction of over 13,000 people.
13,000 in one quarter. That is massive.
It's huge. And they aren't done. They're targeting $5 billion in OPEX operational expenditure savings for 2026. Shulman referred to this as building a war chest.
That is a very polite way of saying corporate austerity.
It is brutal efficiency. The plan is to cut the fat, redundant management layers, legacy IT systems, real estate footprint, and reinvest those savings directly into customer experience and AI-first operations.
So they want to be the leanest operator in this sector.
They're basically saying we can do more with less if we use technology correctly.
This brings up a huge execution risk, which we need to talk about later. You can't just cut 13,000 people and expect everything to run smoothly. But let's look at the guidance first. They cut costs, they hold revenue flat. What does that do to the earnings per share?
It drives a step function improvement, to use their words. They guided 2026 adjusted EPS to a range of $4 to $4.95.
Okay.
But the number the street really fell in love with was the free cash flow. They're guiding for greater than or equal to $21.5 billion for 2026.
Whoa.
That is the highest expected performance since 2020.
$21.5 billion in free cash. That is a staggering amount of liquidity. That's a cash printing machine. And part of how they get there is by cutting the capital expenditures, right? The CapEx diet.
Correct. For years, the story with Verizon was build 5G. They were spending billions buying C-band spectrum and putting up towers. That phase is largely over.
So CapEx is stepping down.
Stepping down to a range of $16.5 billion.
So the heavy lifting is done. The network is built.
Effectively, yes.
Yeah.
Tony Skiadas said they are narrowing the focus strictly to mobility and broadband. If a capital project doesn't drive growth or delight the customer, it gets cut.
And that flows straight to the bottom line.
That $4 billion reduction in capital intensity flows straight to the free cash flow line. It's no longer about building everywhere. It's about filling the network they already built.
Okay, so we have a leaner company spending less on towers and generating more cash. But we have to address the elephant in the room, or maybe the fiber in the room, the Frontier Communications acquisition.
Right, that closed January 20th.
How does that fit into this lean and mean narrative? Buying a massive fiber network doesn't sound very lean.
It sounds heavy, doesn't it? But the logic here is what they call convergence. This is the holy grail for telecom right now. The data shows that if you bundle a customer's mobile plan with their home fiber plan, churn drops by 40%.
40% reduction in churn? That's massive. That's almost cutting your customer loss in half.
It's huge.
Yeah.
If you can lock a household into both your fiber and your wireless, they basically never leave. It's too much hassle to switch.
You become the utility they can't fire.
Precisely.
Yeah.
They want to own the entire household infrastructure. They want to be the pipe for everything. And with the Frontier deal closed, they are aiming for a fiber footprint of 40 to 50 million passings over the medium term.
And they raised the synergies on the deal, too.
They did. They now expect $1 billion in run rate cost synergies by 2028, which is double what they initially told us. So they think they can squeeze a lot of efficiency out of that merger.
So the strategy is own the home, own the phone, cut the costs, and count the cash.
That's the bumper sticker.
All right, let's talk about the thing that probably squeezed the short sellers the hardest, the shareholder returns. Because usually when a company says we are in a turnaround, the shareholders are the last ones to get paid.
Right. Usually you cut the dividend or pause buybacks to fund it.
Not this time.
Not this time. And that was the shocker. The board authorized a $25 billion share repurchase program.
$25 billion. For context, at the pre-earnings price, that's almost 15% of the entire company.
It's a massive signal. This is the first buyback authorization in about 6 years. And Shulman didn't just leave it as an empty promise.
Ooh.
They committed to buying back at least $3 billion in stock in 2026 alone.
Plus, didn't they bump the dividend?
They did, increased for the 20th consecutive year, payable in May. So think about the setup here for a value investor.
Go on.
You have a yield of around 6%, you have a massive buyback floor under the stock, and now you have a volume growth story. It's the holy trinity for value funds.
That explains the volume. The income funds have to own it, the value funds have to own it, and now the growth funds are sniffing around because of the subscriber ads.
It's a perfect storm of demand for the shares.
Yeah.
The market completely ignored the flat revenue guidance because they are focused entirely on the operational leverage. If Shulman can deliver the same revenue, but with $5 billion less cost, the stock goes up. It's simple math.
But, and there is always a but on this show, we have to look at the risks. This sounds perfect on a spreadsheet. Just cut 13,000 people and automate it with AI. But the real world is messy.
It is.
And Shulman acknowledged a stumble right out of the gate, didn't he?
He did. And to his credit, he owned it immediately. He opened the earnings call by apologizing for a recent network outage. He called it a failure to meet the standard of excellence.
That's the danger zone. Verizon's whole brand is reliability. Can you hear me now and all that? That premium brand perception is the only reason people pay more for Verizon than for a budget carrier.
It's everything.
So if you cut 13,000 staff and you slash capital spending by $4 billion, doesn't the network have to suffer?
That is the show me aspect of this story. You're trying to do two opposite things at once. Cut resources and improve quality. Shulman is betting heavily that AI and automation can fill the gap left by those 13,000 employees.
But if we see another outage,
Or if customer service wait times skyrocket because there's anyone left to answer the phones, this narrative just crumbles.
right, you can't automate a technician climbing a pole to fix a line during a storm. If the physical infrastructure degrades because you're on a CapEx diet, customers aren't going to care about your EPS. They're going to switch to AT&T.
Exactly. And U.S. wireless is still a scale game. Verizon is proving it can win subscribers back right now, but execution is everything. Those quarterly checkpoints on that 750,000 ads target are going to be scrutinized heavily.
It's a high wire act. There is no net.
If they miss a quarter, or if the network wobbles, this stock could give back those gains very, very quickly.
All right, we've covered the print, the pivot, the Frontier deal, and the risks. Now let's get into the fun part. The part where we look at the board and say, what if?
It is time for our This Is Not Financial Advices segment.
And the disclaimer is key here.
Please remember, everything we are about to say is for entertainment purposes only. Do your own diligence. We are not your financial advisors.
And we are definitely not suggesting you bet the farm. Don't sue us, we're just reading the tea leaves. Okay, here is the outrageous trade idea. I call this the cannibal cash cow squeeze.
I'm listening. A cannibal cow. That's a new one.
Hear me out. The thesis is simple. Verizon is turning into a deflationary asset. They are printing $21.5 billion in cash. CapEx is dropping. And they just authorized a $25 billion buyback on a stock that, until yesterday, was trading in the high 30s.
So you're betting on the float disappearing? You think they are going to buy back so much stock that it forces the price up?
Exactly. The trade is to go long the 2027 LEPS, those are deep in the money call options, and sell short-term out-of-the-money puts against them.
So you're setting up a synthetic long position with a kicker.
You are betting on the Shulman grind. He cuts costs, free cash flow goes up, and he uses every spare dime to eat the float to cannibalize his own share count. It's a slow-motion short squeeze on their own stock.
Okay, I see it.
If the stock stays flat, the buyback eats the supply, and your deep-in-the-money calls appreciate just on the delta. You're leveraging the buyback mechanics.
It's aggressive, but the math holds up. You're essentially leveraging the buyback. If they hit that 4.95 EPS and the market decides to put a 12 or 13 multiple on it, which is standard for a healthy utility, you're looking at a stock in the 60s. Easy.
And here is the wild kicker. If the convergence play actually works with Frontier, Verizon becomes the only utility in the country you cannot fire.
Right.
This stops being a telco trade. It becomes a monopoly of the household infrastructure bet.
And infrastructure bets love falling interest rates.
Exactly. If rates get cut in 2026 or 2027, this thing reprices like a bond proxy on steroids. You get capital appreciation plus the dividend. It's a way to play the turnaround with leverage, assuming you believe Shulman doesn't break the network.
It's a plausible scenario. The risk, of course, is that the cost cuts degrade the product. If the customers leave, the cash flow dries up, the buyback stops.
And your NEPS go to zero.
That is the risk. That's why we call it the outrageous trade idea.
But right now, the momentum is undeniable.
It is. Verizon delivered a monster beat on volumes, promised a leaner operation, and threw a massive buyback bone to the bulls. It's hard to bet against that kind of cash flow in this market.
The turnaround is officially underway, but as always, execution is everything. Can they cut 13,000 jobs and improve customer service simultaneously? That is the billion-dollar question for 2026.
They'll be watching those subscriber numbers like a hawk next quarter. If that 616K number drops to zero, the party is over.
Absolutely. Keep watching the tapes. This is Talk Tickers. Over and out.